Hey guys, so let's now get into grips with international competitiveness in a bit more detail here. Let's have a look at some of the overall factors that can really determine international competitiveness. Okay, so number one, exchange rates. Exchange rates, of course, will affect pricing levels of your exports. We're aware of the little acronyms that we've got here. So for instance, SPICE. If the exchange rate appreciates, we've got strong pound, imports cheap, but exports become dear. That will hurt your international competitiveness if there's an appreciation of your currency. Number two, inflation. Well, if inflation is high within a given country, of course those export prices again are going to become dearer. They're going to become more expensive. That's going to hurt your international competitiveness. Number three, productivity. If you can reduce your unit labour costs by ensuring that your labourers can now increase output, then that's going to be great news, because that is really going to help to enhance your competitive position within international markets. So that's good news. Number four and number five, closely related, okay, and they're about non-price competitive elements really, okay. So quality and research and development. So this research and development, that's likely to influence the degree of innovation that goes into a product, and therefore the unique selling proposition or unique sales proposition that a particular export actually possesses. Okay, so the better the quality, the more competitive your goods are likely to be, but of course they won't necessarily be price competitive when it comes to those two elements. Then we've got wage and non-wage costs. So if wages rise, of course, well, that is of course going to mean that unit labour costs are likely to pick up. When it comes to these non-wage elements, this could be additional costs. So it could just be general costs of doing business, like more expensive telephone bills, broadband, heating, lighting, and so on. Those non-wage costs can also really dramatically influence competitiveness. And number seven, the degree to which a business is regulated. The more heavily regulated an industry is, the greater the additional costs are likely to be in making sure that a given company is actually complying with all regulations. Okay, so those are our big factors when it comes to actually determining international competitiveness, but let's look at how we can actually improve a country's position when it comes to that competitiveness. Number one, through supply-side policies. Now, supply-side policies deliberately try to influence the supply side of the economy, as of course the name suggests. Such examples could include education. Education may help to actually boost labour productivity. Now, that's important. Number two there, the second point in relation to supply-side policies I've put down is about innovation. And we can see that we refer to this point here. So if you have a more creative, more entrepreneurial climate, which actually supports more innovation, and there may perhaps be tax breaks provided for research and development and further investment, well, that could be good news. When it comes to investment in capital goods, of course, that may influence productivity. So that's another important factor. Number two, exchange rate policy. So you want to make sure that your exchange rate does not fluctuate wildly. If it fluctuates quite significantly, it will impact upon your country's competitiveness. And it's going to mean, in all likelihood, against other trading countries that have more stable exchange rates, that people and businesses overseas are going to opt for trading with those countries where they can actually predict what prices they're going to pay in the future. So that's an interesting point. Number three, we've also got the control of inflation and macroeconomic stability. So ensuring that inflation is kept relatively low is going to be good news in terms of helping a country to maintain its international competitiveness and ensure that its current account or trade balance does not worsen too dramatically. And we've got this point about macroeconomic stability there as well. Well, macroeconomic stability will help to actually breed confidence within an economy, and that will maintain demand for a country's currency, of course. So there's a large number of factors at play here, but there's some great stuff, and this is nice and straightforward to consider within any essay on boosting a country's trading position. Great stuff, guys. We'll leave it there.